Okay, today we are going to discuss an issue relating to capital budgeting and particularly domestic capital budgeting. This topic is in line with the one financial management and also C3, the corporate finance. I will concentrate on non-discounting criteria relating to ARR, accounting rate of return, as a decision method. Formally, in capital budgeting, there is capital budgeting as its definition is investment in a project which exceed one accounting period. And before accepting as to whether to invest or not, there are several methods for this decision. These methods are grouped into discounting criteria and non-discounting criteria. For discounting criteria, we have three methods. The first one is NPV. Then we have internal rate of return. Then we have the so-called price profit index ratio. And we have this IRR, internal rate of return. For discounting, non-discount cash flow, we have payback period, and we have the accounting rate of return. So today's session, I will concentrate here so that you can understand it clearly. So I will beg your attention for almost 2 hours so that you can grasp something on it. Let me start from the beginning, as I said, to make everything okay. I'm discussing about capital budgeting, which defined as a process of identifying. First of all, in capital budgeting, we have the following steps. Number one, capital budgeting, step one, you have to identify. That is step number one. You identify the cash flow. Number two, you analyze. You analyze those cash flow. Step number three, you select. So select investment project. Selecting project. So which project to implement? Now from these steps, identifying does not need the computation. You just identify which cash flow. It's a paperwork. Analyzing also is a paperwork. But selecting the project, you need a computation. That's where you need computation. And here, you need to use these 5 methods, which have been defined here. So, as it is defined, that capital budgeting involves identifying, analyzing, and selecting investment project whose cash flow are expected to exceed 1 year. So if you have a project for 5 months, it does not qualify being capital budgeting because it's below 1 year. So the cash flow must exceed 1 year. For example, investing in agricultural projects. And if the project will be there for the life of 5 years, then you need to make initial out cash flow, interim cash flow, and final year cash flow. So that qualify being capital budgeting. Before going further, we should know the types of cash flow that may be arising during capital budgeting before going to the decision. There are three also types of cash flow. The first cash flow is initial cash flow. These are the cash flow which may be incurred at the start of the project in year naught or year one or whatever. For example, if you want to establish a manufacturing company in Tanzania, perhaps, for example, a cement manufacturing or a wine manufacturing, the initial cash flow may be involved in acquisition of land, acquisition of machine, acquisition of plant, property, equipment, installation of machine, payment of freight on those equipments, payments of taxes, installations, and others. Those are the types of cash flow that may be classified as initial cash flow, and that is investment. We call them initial outlay. So we have this land, machine and plant, installation, testing, freight insuring, non-refundable tax, networking capital, and others. Those are initial cash flow. So you incur them when you start a project. We call them initial cash flow. Number two is interim cash flow. Interim cash flow are the cash flow which arises when the project has started generating, it has started producing products, it has started earning. So there is an operation within the project. So this cash flow may result into preparation of income statement. So you must estimate the number of units produced during the operation. You must estimate how much is a selling price per unit. Again, you must establish the variable cost of running the projects. Also, you must describe the fixed operating expenses to run a factory or a project. Then there is a depreciation, because actually, when a project is running and you have some property, plant, equipments, when the equipments depreciate, so this is a depreciation to be accounted. We have inflation. Inflation is being accounted because actually cash flow will be passing through different years, so which is subject to inflation in real terms. Okay, those are the interim cash flows. Next, we have the net salvage value and recovery of working capital in final year cash flow. So final year cash flow, these are cash flow which arises when the project is finalizing. So if you are finalizing a project, perhaps you will be selling your plant, you will be selling the motor vehicle, you will be selling the non-current asset, and once you sell them, you pay tax. So the net selling price net of tax is what we call net salvage value. And there is a recovery of working capital at the year end, while at the year start, there is initial working capital. So that's very important to note when getting this. So for capital budgeting process, as I said, you classify cash flow into three categories. Initial cash flow, we have interim cash flow, and we have final year cash flow. Then you establish where to locate. Initial cash flow are here, and the interim cash flow arises here in the middle of the project. Final cash flow arises at the end. I will recommend, if the tax are paid in arrears, then always we have an additional here for settlement of tax if tax are paid in arrears. Okay, let's get started on this and move to what we need to go. So after classifying the cash flow, at the end somewhere, we have now operating cash flow, which is to be discounted by using discounted rate, as it will be identified later. Okay, now the second phase. Which cash flow are to be included in capital budgeting? Actually, in this ground, we have several methods, as I said. But if we want to describe the cash flow for capital budgeting, you must have something technical. Number one, the cash flow that we must include in capital budgeting, it must be one, cash items. So exclude depreciation, deduct depreciation, deduct amortization, deduct impairment. So it must be cash. It must be cash item. Number two, the cash flow must be incremental, meaning that the cash flow must be arising from project itself. You may be having 4 projects, so every project should have its own cash to be considered as a factor to run a particular project. So the project must be arising because of a decision to undertake a project. Where the cash flow are not incidental or incremental, then this is not a good measure. Number 3, the cash flow must be reflecting the future, meaning that the cash flow must be forward-looking. In this ground, don't include research cost. All research cost must be taken away because research costs are past cost, which does not reflect the future. They are called sunk cost in other language. Now, also, do not include finance cost and dividend. So you see now, in operating the project, we don't include finance cost. So the cash flow are operating cash flow. We call them, they are operating cash flow. Don't include the dividend and finance cost. Number 5, the cash flow must be after tax cash flow, meaning that you have to pay tax, and that's why a component of depreciation must have to be considered in this ground. So let me now say enough for this and now go to what is the so-called accounting rate of return in decision making to understand the project. So I will go this way and put some of the demarcation so that you get started. What is accounting rate of return? And what are the basic key issues so that we should get acquainted to what is happening in this method so far. Accounting rate of return is actually, this is a formula that reflects the percentage rate of return expected on investment or asset compared with initial investment cost. The IRR formula divides asset average revenue by the company's initial investment. In other definition, we say that accounted return is the amount of profit or return that you divide by asset or investment. Now, in this area, we must be very much aware on this discussion because we need a thorough understanding on this method, accounting rate of return, how to handle it. Okay, now let me take a normal understanding in this ground. I want to make it so that we don't confuse. For example, let me draw the line here. This is the line demarcation. we are having year naught, we are having, let's say, case 1, or let's put the general case. What's happening here? Year naught, year 1, year 2, this is year 3, this is year 4, and this is year 5. If a company is now thinking of a 5-year project, number 1, a project manager must estimate the initial investment. How much is the investment here? Initial investment, and also the residual value at the end. The residual value at the end. So, the residual value at the end. Also, if there has been an additional capital, working capital at the mid of the project. Now, lastly, the project manager must estimate how much the project is going to earn. So, we need to see revenue. And we need to estimate the expenses each year. Now, the IRR is now telling us as follows. You must be very much aware here. The IRR, as per the formula, saying you take the average profit, over average investment times 100%. This is what is the formula telling us. So you must produce 2 working. Working 1, you compute the average profit figure. So the average profit figure, you have the following. Average profit, you have the following. For example, you may put in so we have year 1, year 2, year 3, year 4, year 5. So you estimate the revenue in those years. So we estimate them, how much is the revenue in each year. Number 2, expenses. Running expenses, including depreciation itself. So we have other expenses, including depreciation. So in black are other expenses. So what we have here is now the profit. Right here, profit in year 1, profit in year 2, profit in year 3, profit in year 4, profit in year 5. It's technically easy. remember, these profit are not considered for the time value for money. So the average profit is the total profit divided by number of years. So average profit is defined as total profit for the period of project over number over duration of project. So average profit is defined, average profit is defined this way. So remember, it may happen that perhaps in year 3 there is a loss. So you must put negative because average profit over the year. Now a problem arises in estimating the average investment. The problem arises in estimating the average investment. So working number 2, average investment. There are some cases that I can now make it. For example, generally, average investment is taken as initial investment minus salvage value in bracket over 2. I repeat, average investment is taken as initial investment minus salvage value over 2 plus additional plus salvage value plus salvage value plus additional capital. So this is a formula. This is a general formula if you have been given those instructions there. So you have initial investment, which is here. You have residual value, which is here. And then you have additional working capital. So you take initial investment minus residual value divided by 2. And then you add residual value, you add the additional working capital. That is very important from this one. So getting this one, we have now 2 workings, and then you can now solve the problem. Depending on the information being provided, there are several approaches which you can use. For example, if no salvage value is provided, case 2. Case 2, if no salvage value, for example, meaning that a project has only initial investment. So you have year 5 and year not. So here initial investment has been provided. We have initial investment, and again no salvage value here. So what is the investment so far? And no additional capital. So investment itself, we call it average investment, is the only initial investment. So you just take the average investment is only the initial investment. Then you go. Second, I might have to discuss before going to some vivid examples. Let us see what is advantages and disadvantages of using this account rate of return. The very big limitation, the advantage, we start with advantages. The account rate of return is simple. It does not require complex mathematics. You see, it is simple and it does not require complex mathematics. This method of capital budgeting is simple to understand and use. Very simple to understand and use it. So, we advise people who does not have a big knowledge on investment computations use this method. It's very simple to compute and very simple to understand. You just take the average profit, you divide by the duration of the project. Number two, this method in hand when the investor or managers need to quick compare the returns of project without needing to consider time frame or payment schedule, but rather just profitability or lack therein. So this method is applicable when the project manager does not require time value for money. You want to see profitability without considering time value for money. So very important when a manager need a quick evaluation of project without considering the time value for money. That is how this is to be considered. Again, accounting profit over the economical life of the project are considered in evaluating the project. The required data are easily available from the financial firms. Actually, in this accounting rate of return, it's easy now to observe financial statements of the firm of the past year or whatever, and then consider this method easily. So financial information are obtained from financial statements easily. Disadvantages. Actually, because in actual sense, this method does not accommodate the time value for money. Now, when it comes to practice, you can see the economical factors that time value for money, because 1 million of this, 1 million today is not 1 million tomorrow. Therefore, the disadvantage of this method that it does not accommodate the time value for money. The time value for money is a concept that money available at the present time is worth more than identical sum in the future because of potential earning capacity. So this is the first weakness. The second weakness is that the investment might yield uneven annual revenue streams. What is uneven annual revenue streams? This is a stream of revenue which sometimes, perhaps in 1 year you get 0, another year you get positive, another year you get negative. Where those uneven revenue arises, but this method does consider the average over the period. While at the mid, there are some uneven revenue which may mislead a decision maker. When you consider the average of the period, it overlooks the uneven revenue, which is even dangerous at the mid of the project. So this is the second weakness of this method. Number 3, this method, accounting profit is taken into consideration instead of cash flow from the project. So it only consider accounting profit, but does not consider incidental cash flow from the project. So it may happen that some cash flows which has been included is not relevant to the project itself. And once you implement a project, you get problem on achieving the objective. Again, this method is inconsistent with objectives. This method is inconsistent with an objective of maximizing shareholders' wealth. So it does not maximize shareholders' wealth, the owner of the company. Rather, it has its own meaning of measurement. Again, it's arbitrary cutoff. Firm using average rate of return use arbitrary cutoff. It does not explain when to stop considering the project period. So the cutoff is not defined. It is arbitrary. We can see some other limitation with this method in details as follows. The first one, we have discussed them, but this one here, it does not consider the increasing risk of a long-term projects and the increasing variability associated with prolonged project. So this method does explain about prolonged project, but it does not explain the risk that may arise when a project manager extends the project. Also, this method is just a guiding rule for evaluating the project. So sometimes projects are proposed and implemented to enhance other important variables such as safety, environmental concern, or government regulations. So it is how it works. It is not an ideal comparative matrix. So it is not an ideal comparative method because different projects have different variables such as time and other non-financial factors to consider. Okay, now let us go to computation, and I will show you physically and practically how to handle some examples. This has been worked with this document. So these are examples we are solving, and I will go for practical. XY company is looking to invest some of new machine to replace its current manufacturing one. The new machine, which cost $420, would increase annual revenue by how many? $200. And the annual expenses is expected to be $50. The machine estimated life is 12 and 0 salvage value. Now compute the accounting rate of return from this. It is practical that you should go for this one here and see how to handle the problem. We may establish what happened here. XY company is thinking to invest in a project of 12 months. So demarcation. We have here not, and we have here 12. The initial investment, as he said, the machine will cost $. The machine will cost $420, and the residual value is 0. The new machine will cost would increase revenue for this one. So revenue per year is $200. revenue per year is $200 and expenses per year is $50. Now, in this ground, you can see the first working. Number one, what is the total revenue so far? So we need to compute average profit. So average profit, we need the sales so far. Sales revenue for 12 years. So you multiply the 200 by 12. So in average, you have, let's see it here, 12 times 200. It is 240. Expense, again, it is 12 times 50 from the understanding. So 50 times 12, it is 6, if I'm not mistaken. Yes. Now, this is a profit this is sales for 12 months and expense for 12 months. Now, what is a profit for the period? You deduct. So 2400 minus 600 get 180. This is a profit for the period. Now the formula says average profit. So average profit is equal to this profit divided by 12. So divided by 12. You get 150. So average profit can now be computed here. Average profit can now be computed. Average profit is $100. So 1,800,000 divided by 12. So the profit will be this one here. Now it comes a problem with how do we get work number 2? As I said, this method arbitrarily you need to estimate. There are 2 approaches here. The ratio value is equal to 0. Initial investment is $20. So additional capital is 0. So 2 approach. That average investment can just be equal to initial investment. So here no problem. This is $420. But other reader can use average investment equals to dollar this plus 0 divided by 2, which is $2.10. So there are two figures. All these, once you use them, don't worry, just state in the formula as to which method are you using, whether this one or this one. So in computing for the IRR now of this project, using method 1, so case 1, can say IRR is equal to $150 over $420 times 100. If you use the first assumption that the profit, the initial investment equals the average investment, so divided by 420, so 50 divided by 420, 13%, so 36%. In case 2, also IRR is equal to 150 divided by $2.10. If average investment, you have used the average of ratio of being 0 and others. So 150 divided by 210, then it is almost, that is difference so far. It is increasing in the value because we have rise to 75%. As I said, many people can use more judgment. Let us see how this examiner did this method. We have, we need to consider depreciation somewhere. Do we have something missing here? Yes. We need to consider depreciation. Well, this machine is depreciated over 12 years, so must be considered in evaluating the profit. So the profit is wrong. We must adjust it here. Depreciation of the plant. Do not consider depreciation because annual depreciation, it is annual depreciation 420 divided by 12. 420 divided by 12 is 35. So 12 times 35, which is 420. So profit, it is 240 minus 60, then minus 420. So this is 138.0. So average profit will be calculated here. Average profit and then be calculated here. Average profit is equal to $138 over 12. 138 divided by 12. So this is $115. When you're looking for profit here, the first one is now the profit, which is $115 over $420. 20 times 100%. 115 divided by 420. 27%. If you use the former, this one here, so it is $115 divided by that one here. So 115 divided by 210. This is almost 54%. So the two formula can have this and then make a computation. It depends which method you use to compute. So this was the way it works. So this one, from this example, the examiner uses the letter that average investment is the average between 0 and the initial investment. It getting 54% as we did in case number 2. 54%. So don't worry when these figures comes difference, but rather consider which formula did you use during computation. Let's see here also. XYZ company is considering investing in project requires initial capital of 100 in some machine, and there will be a net flow of 20 in the first 2 years and 10 in year 3 and 4 in year 5. Finally, the machine the machine has a residual value of this amount. Actually, in this ground, the cash flow are uneven. They are flowing difference. Now, technically, the useful life of the machine is 5 years. The first step. The useful life of machine is 5 years. So a problem is to go with how to handle this question so far. Let me summarize it. Working number 1, computation of average profit. There are 5 years so far. So 5 years. How do we get the profit in 5 years? So we have year 1. Must be very clear, yeah? So we have years. So year 1, year 2. Let me put it together. Year 1, 2, year 3, year 4, year 5. Number 1, revenue. The sales are estimated to be 20. There will be a net inflow of 20 for the first 2 years. So first 2 years, this is 20. This is 20. Again, he said 10 in year 3 and 4. 10 in year 3 and 4. Again, 30 in year 5. 30 in year 5. This is inflow. It says inflow. This is an inflow. Net inflow. So net inflow. It's not a sales. Net inflow, meaning sales minus expenses. Net inflow. Now, from this net inflow, we have depreciation missing inside. So, depreciation is equal to initial cost minus salvage divided by useful life of the machine, which is 5. So 100 minus T30 somewhere. Such value will be 25 or so, 25. 25. So I better take this away. Now to bring problem here, first bring down this. Okay, what I want to make it depreciation. I want to compute depreciation here. It is 100 minus 25 divided by 5. So this is 75 divided by 5. So this is 75 divided by 5, then 15 so far. So from the net income, you have depreciation being added here. So 15 in each year, 15 in each year, 15 in each year, and 15 each year. So profit can be computed in each year. So this is 5, this is 5, this is negative 5, this is negative 5, and this is 15, but positive. That is a profit we are looking. Now average profit, you add 5 plus 5 minus 5 minus 5 plus 15 divided by 5. So likely this 5 and this 5 and this 5 and this 5 cancel out. So you have 15,000 divided by 5, which is 3,000. This is the average profit. It is $3,000 average profit. Remember, as we said, when there is an even profit, the even revenue, the method of RR is a shortcoming. For example, the revenue in the profit in year 3 and in year 4 is a minus. But now we're taking the average. So we have the average of 3,000 per period. So we are left with the average investment. Average investment is now a problem. Working to average investment. So let's place a demarcation here to have a meaning. Initial investment, and so we have initial investment, and here we have the residual value. Initially we have invested $100. That is an initial investment. The residual investment, sorry, the residual value is $75. Sorry, 25. Now there are two methods here of getting the average investment. Case 1, as I said, there are several people having similar view. Case 1, average investment, one can say 100 minus 25 divided by 2. As I said, there is a theory formula which is being used from this method. That's why we have an arbitrary assumption. So this is 75 divided by 2. 75 divided by 2, which is $37,000. Or case 2, average investment. Some people will put the average investment in some books. They take 100 plus the salvage value and then divide by 2 in some other books. So you have 125 divided by 2, which is $62. So both of these methods are applied in different sessions. So we had to work on. So what is expected here when computing RR? I said there are several methods of getting started to have an average investment. For example, we have these two methods here, and different books will use different assumption. Now we have computed the investment. So case 1 also is possibly to have the two. Case 1, so IRR is equal to $3,000 divided by $37,500 times this one here. So this is the first case. Let's see, divided by 37,500 is 80%. 8%. For case 2, then IRR is $3,000 divided by 62.55 by 100. Yes. So how much is this? 3,000 divided by 62,500. So 4.8%. So now what were we observing here? In order to make a decision, a project manager must establish the management decision for IRR for comparison within the project. For example, if I add part 2 here, part 1 is compute IRR, part 2 if the management has 5% return, has return 5% as required rate of return, then comment on acceptability of project. So after computing the IRR, you compare with the acceptability. So for the first one, it is 8%. Based on the 5%, you accept the project. But for case 2, you had 4.8%. Then for case 2, meaning you have to reject this one because it's below the required rate of return. So even this solution, as you see it has several computation based on different methods. So he used this method here, which is average, so almost 4.8%, and therefore I think you are aware on it. Let's see here what happened to question number 3, so that I can either compute it or not. Initial investment, it is 130. It is expected to generate an annual cash flow of $32,000 for 6 years. Depreciation is allowed on straight-line basis. It is estimated that the project will generate scrap value of $10,000 at the end of 6 years. So you can solve this one here, and I'm sure there's no problem. There's no problem. I'm sure you can solve it and have. So see, as here, initial investment, it is minus sign. So sometimes minus sign, sometimes people use the other way around. This is simple to go through. Let's see question number 4. The following information has been given in respect of cash flow of 2 projects. That's very interesting. So we have 2 projects here. You have project A, the cash flow. The cash outflow is this 220 million. Cash inflow is 91, 130, and 105. Such value is this 10. Project B, investment is 198, and the cash inflow is 87, 110, and 80. Such value is this much here. Now compute IRR of each project. Advise the management on which project should be selected if desired rate is 19%. Discuss the advantages and the disadvantages of IRR. As I said, it is simple to compute, and also it is applicable when a project manager or a company is thinking on decision without considering time value for money. Disadvantages, actually, it does not include some of the cash which is incidental to the project, but also it does not consider the time value for money. Now, in order to arise on this decision, we should have a way forward on how to compute. As I said, there are several methods of how to treat this one here. Let us start with demarcation here. So let me see here, project 1 so far. Let me start with project 1, project A, and then project B, so that when you understand them, it's possibly you can. Both of these projects, these are the 3-year projects so far. So I will start with project A. Project A. So far, project A is having an initial cash flow in year 0 and the final cash flow in year 3. So what is happening? The initial investment is estimated as 220 million, and residual value is estimated at 10. These are dollars. So $10 million. So year 1, year 2, and how much is this? Yes, year 1, year 2, year 3. So year 2 and year 3 here. So this is year 3. There are some cases here. For example, we needed to go through, yes, how would we compute average profit? Working 1, average profit. So we must be aware. So year 1, 2, year 3. What are the average profit? We have net cash flow. Net cash. So the net cash for year 1, 91, 130, and 105. 91, 130, 105 in million. Those are the cash inflow. But the sale value is 10. So first we need to compute the depreciation charge on this project. Depreciation charge is equal to 220 minus 10 over 3, because the project is a life of 4 years. So this number minus this one divided by 3. So 220 minus 10 divided by 3, 70 each year. Depreciation is 70 each year. So having this depreciation, so it is 70 year, 70 year, and also this is 70. So we have a profit so far. What's the profit in year 1? 91 minus 70, it is 21. What's the profit in year 2? 130 minus 70, it is 60. What's the profit in year 3? 105 minus 70, it is 35. So this is the profit. Now, average profit can now be computed. It is 21 plus 60 plus 35 divided by 3. So this is 21 plus 60 plus 35. 106. 160 divided by 3. I repeat, 21 plus 60 plus 35. 116 divided by 3. Okay. This average is 38.6. 38.6 so far. Now, how do we get the average investment? This is now a problem comes. Working 2, average investment. This project has 3 years, and we had initial investment in year note of $20 million, and the residual value, this is $10. So, as I said, there are different methods of having the average investment so far. Average investment. we can take 220 plus 10 divided by 2, which is 230 plus 10 divided by 2, which is 2 plus 10, it is 230 divided by 2. So 230 divided by 2, it is $115 million, or the other way around, perhaps case 2. Case 1, case 2 can have different answers because people are using different answers. So in this way, project 1, let us use case 1 in both cases. So IR for project T, IR for project A, it is $38.66 divide $115 times 100. The result IR is 34% on project A, because we have been asked that since the project manager has a desire of 19%, then project A should be accepted based on IR. Since IRR is 34 greater than desired rate of 19%. Hence, project A is accepted. Project A is accepted. Now let us see project B also, so to make a comparison on it. Project B also has its information. Project B, this is the information we are having. So let us consider project B. Project B is also considered here. Let us start with working one. Working one on average profit. Now it's easier because depreciation is well defined as 198 minus 18 divided by 3. Depreciation here is 198 minus 18 divided by 3, 60. Depreciation is 6 per year. So possibly we can now estimate here. We have year 1, year 2, year 3. So net cash flow, it is 87,110, and we have 84. Depreciation is 60 in each year. Then we have profit. So profit 37, 60, 27, 10 minus 60, it is 50. Again, 84 minus 60, it is 24. So average profit is easy to compute. It is 27 plus 50 plus 24 divided by 3. So 27 plus 50 plus 24. It's 27 plus 50 plus 24. So we have $34 in average profit. Now we need average investment. So average investment is 198 plus the salvage value, which is 88 divided by 2. So average 198 plus 18, 216 divided by 2. This one comes in to be 216 divided by 2, 108, 108 million. So we can compute the IRR for project. IRR for project B is $34 million divided by $108 times 100. Yeah, that's million. Yeah. So what we're taking here is 34 divided by 108. This is almost 32%. Now, how do we comment here? So we're saying since the IRR for project B is 32% above the desired rate of 19.5%. Hence, project B will be accepted. Now, it may be very technical on ranking. On ranking, if the company has insufficient funds to execute these projects, what is the first priority? So ranking 1, and then ranking 2. Project A had 34. IRR, required rate of return is 34. So IRR and so project implementation. place this table. The first, baking, second, ranking, second, ranking. So which project is first ranking? It is project A, followed by B. What is IRR? Project A is 34. This is 32. So even if they are both profitable, but project A is the most profitable and given the first ranking, if there are insufficient funds, this is the project to be implemented first. So I think you have done something on it. Let us get started to another problem again. The following information has been extracted: investment and after tax. Compute IR. Now this is cash flow and this is investment. At this level, you can observe that investment has been regularly throughout the period of the project. Now, how do you get the average investment? That's where you need to be very much aware on this computation here. So average investment, it is defined under this formula. I repeat, this problem involves regular investment over the period of 5 years, and this information has been computed as after tax cash flow in million. So average investment is initial investment plus installation cost and minus salary divided by 2 plus additional working capital plus surgery value. Average profit, no problem. So in our computation, we have investment over 5 year streams. So you take these investment, you sum them, and then you divide by the period itself. That is an average investment so far. And no such value so far. So you take it in this formula, average investment. You sum them, you divide by 5. Again, this after tax profit, you sum them and divide by the duration as it has been indicated here. Finally, you compute the IRR as usual, and then you get the RR equals to 72%, and you can now recommend whether to accept it or not. So this problem, I have involved it because investment is done over the whole period of project. So you take the average investment over the period of investment. Okay, let's see this one here, number 6. If initial investment of XY Limited in buying a machine is this amount here in million, 121 million. So this is 121 billion. So value is 11 billion. Working capital. So this one has a working capital being added of 12 billion. A machine is 5 years and straight line method. Here, remember the way it works and the way I told you on how to handle the investment in a working capital. Do we have buying machine? So compute average investment. Yes, this one is simple because no annual profit, so no RR. So it was a procedure when there is additional capital, how to handle the problem. What he's saying here in the diagram, let me go through the diagram. He said, initial investment of XY Limited. There is initial investment. Sorry. There is initial investment. And we have here note. Again, we have here 5. But in between, there is here 1, here 2, here 3, here 4. So a working capital has been added. So we have additional working capital. Figures indicates the following so far. So we have initial working capital here, initial investment of 121 billion. 121 million. And additional working capital is ZS 12 million. And the salvage value is here. Salvage value is ZS 11 million. Now compute the average investment. I said this average investment is defined as initial investment minus salvage divided by 2. That was the first component. Second component, you add salvage and then you add additional capital. So in our computation, initial investment is 121,000 minus the salvage is 11 divided by 2. So you add the salvage 11 plus additional capital, which is 12. Okay. So 121 minus 11 is 120. 110 divided by 2. So 10 divided by 2 plus 11 plus 12. So our average investment is 55 plus 11 plus 12. Average investment, now you sum them easily. 55 divided by 11 plus 12. This is ZS 78 million. So this component analyzes when there is additional capital. So take care to handle issues when there is additional capital. Okay, let's see another component here. If two machines details are given below, which one should be chosen on a basis of IRR. So there are two machines. Initial cost for the first machine is this million. Initial cost for the second machine is this million. And you have estimated annual income after depreciation in that. So this is estimated annual income after depreciation. The concept here is to see this one here. These are information after depreciation. As you see, the total profit after tax are the same. Although in year 1 it was 13.37 for project A, in year 2 it is 21,375. So the same cash flow, but once you sum, there are difference. They are what we call uneven cash flows when you compare it with project 2, but the total are the same. Now, if you want to decide on which to implement, you will see that this machine have the same outlay, but initial investment, the cash flow outlay are uneven here. So it is not possible. That's why we have a shortcoming of IRR, that IRR will not make a proper decision when the cash flow are uneven. So project A and B would be deemed to have the same IRR because of the nature of the formula, but the cash flow are not the same. They arises in different figure, but when you sum the total, they are the same. So computing here, the first step is to compute the average profit by dividing by the initial investment. So once you take this is a profit, if you divide it by 5 years, you get a same number for product for machine A and machine B. As you see now, the IRR will be the same. For example, investment IRR for what machine will be 25 here. So 20.4 for all machines. So actually, for the numerically, it's not possible to say which machine is better than the other because they are similar in that. So from numerical example, any machine can be chosen as both the machine gives similar results. But the fact is, in the case of B machine, the return are higher in area years. In area years for machine A, machine B, yes, they are higher. 21, again 19, they are higher in area years. While machine A returns are smaller. But in machine A again, returns are higher at the later stage. So when you compute average returns on both machines, they are the same. So that's why we were saying this method is having a shortcoming because it can't differentiate projects which have such kind of cash flow. But if you use the internal rate of return or net present value method, you could see the decision might be a different case. I will try to comment on this to see if another alternative can be made arbitrary here. Let me choose a question here that, for example, if in this case now we have no decision using IRR, but the same question, let's say 7B, on a basis, say if two machine details are given below, one will be, which one will we use on the basis of now, basis of NPV using the cost, if the cost of capital, if the cost capital is 12%. Let's say this one here. So now, using this one, you can see you need to discount the cash flow of this machine and also this machine. You could see the difference in NPV. One might be higher than the other because the time value for money has been costed. So I'll leave this as an exercise for you to go. Okay. Let me see another case which is a bit complicated to handle if you had to look on it. Let me see here. A company is willing to purchase a new machine for Tanzanian shillings 100 million. The usable life of the machine is 10 years. At the end of the usable life, the machine can be sold for 50,000 million. The machine will provide additional profit of 800 million every year. Annual expenses on operating machine is 30,000 million. Calculate IRR. So this is also simple, because duration of the project is 10 years. So machine is bought at this value, but I want to see additional profit is 8 years every year for 10 years. So inflow is this one here, outflow the expense, and then I'll be depreciation. At the end, you have this profit here. So it's easy to get for the average and solve for IRR. Initial investment, you take the average of this, and then you solve for IRR, which is the 40. So that one, no problem. You can solve it easily and find it nice. Next, do you have any complication here? For no. The XYZ company is considering investing in a project that requires an initial investment of 100 million for some machine. The following contractual cash flow has been noted. There will be a net inflow of this one for the first 2 years, and this one in year 3 and 4, then this one in year 5. Finally, the machine has a salvageable. Finally, the machine has a salvage value of Tanzanian shillings 24 billion. Then compute the IRR. Number 1. Number 2, advise the management if the desired rate is 10%. So it's easy here again. Annual depreciation is 15. This is 15 billion so far. And cash inflow has been estimated to be 20 billion in year 1 and 2, 10 billion in year 3 and 4, and 30 billion in year 5. So 20 billion in year 1 and 2, we have 10 billion in year 3 and 4, and finally 30 billion in year 5. Annual depreciation is 15 on a straight-line basis. So you compute the net loss or income. In year 1, we have the net profit or net income. In year 2, there is net income. In year 3 and 4, there is a net loss. And in year 5, there is a net income. So the average profit is computed as follows. Average investment also can be computed by taking the initial investment plus the salvage value divided by 2, which is 62.5 billion. And then as you compute the IRR is 4.8, and you can compare this IRR with desired of 10%, then this ground you have to reject it because the company desired 10% IRR and you have 4.8 IRR. So this one automatically have to be rejected. So this is how it works. Number 9, he said Mazinde Limited is considering investing in a project that requires an initial investment of 40 million for some machine. The following contractual cash flow has been noted. There will be a net inflow of 15 for the first 2 years, and 5 million in year 3 and 4, and 35 million in year 5. Finally, the machine will be sold for 5 million. Compute IRR. Advise the management if the desired rate of return is 30. Step 1, compute the annual depreciation, which is 7 million. And the figures, cash inflow is 15 in year 1 and 2, and it is 5 in year 2 and 3, and it is 35 in year 5. Annual depreciation is 7 each year, and the net income or loss, it is 8 in year 1 and 2, and it is a loss of 2 in year 3 and 4, and it is a net income of 28 million in year 5. The average profit is 18 million as per this computation. The average investment is also being computed as 40 plus 5 divided by 2, which is 25.5 million. The IRR is 36, and therefore recommending a desired rate is 30. Therefore, this 36 is higher than 30. So this machine, this investment is acceptable. Mazinde is advised to implement this kind of project because the cash flow are more as good as possible. We had several calculations here, and would like you to consider reading them and solve as much as it could be here. And please take this note to consider such kind of information. So after having said that, thank you for listening. God bless you.